There is no denying ETH's poor performance in recent months. And meanwhile, BTC has made it into six-figure territory, and institutional bulls still see $150,000 plus for digital gold this year. Even so, big players keep nibbling at ETH. Nasdaq-listed SharpLink Gaming recently spent $463 million accumulating 176,000 ETH for their treasury. BTC may have stolen the show this cycle, but there's clearly still some deep demand for ETH. So today, we're looking at ETH price predictions from some of the most prominent forecasters and considering whether they're being too optimistic or too harsh on this cycle's laggard. My name is Guy. Stay tuned. Okay, before we start, a quick heads up. Although we're looking at price predictions today, I am not a financial advisor, and this isn't financial advice. We're just sharing info for education and entertainment, so always do your own research before investing. Now, there's no tiptoeing around this. We'll have to start with the scoreboard. Yes, the ETH-BTC ratio, which just clawed back to 0.023, after plummeting to a 5-year low of 0.017 in April, leaving ETH still down 35% versus BTC year to date. And this disparity is clear in US spot ETF flows. BTC products have attracted $49 billion in cumulative net inflows compared to just $4 billion for the ETH equivalents. To be fair, given that BTC makes up 65% of the total crypto market cap, it's natural to see it draw significantly more capital. So, while $4 billion isn't exactly headline grabbing, it's still a meaningful figure. Also, the bid for ETH is clearly creeping back as corporate entities are starting to accumulate much larger sums of ETH for their treasuries. As mentioned in the introduction, SharpLink now holds a record 188,000 ETH following its latest purchase. At the time of making this video, 10 corporate entities currently hold ETH in their treasuries, with Coinbase and Bit Digital in second and third place behind SharpLink with 115,000 and 24,000 ETH respectively. But third place in that ranking will soon be held by Bitcoin mining firm Bitmine, which just announced it had completed a $250 million private placement to kickstart its ETH treasury. Speaking in a CNBC interview, Bitmine chairman Thomas Lee placed a lot of emphasis on stablecoin growth as the main driver behind the firm's bet on ETH, saying, quote, "The financial services industry and crypto are converging, and it really started with stablecoins because of viral adoption by consumers, businesses, and banks." So, given all the hype, you might be asking, why is ETH lagging so hard then? Well, for one thing, Messari pegs annualized mainnet fee revenue at just $670 million, down 73% versus 2024, while Etherscan data shows daily ETH burn collapsing 99% from last year's peaks. Now, you may attribute ETH's fall in revenue to the rise in popularity of other chains such as Solana in recent years, and that's certainly a big part of it. However, the problem becomes a bit clearer when we consider the activity on Ethereum's scaling solutions. While the Ethereum mainnet remains the leading chain for TVL, activity is exploding further down the ecosystem. Ethereum Layer 2 rollups now consistently process around 11x more transactions per second than Ethereum itself. So, all of that is to say that Ethereum is busier than ever, but earning a lot less per byte. Nevertheless, some deep-pocketed buyers are stepping in despite a foggy future with respect to Ethereum's market position. But how are traders positioned given this dynamic? Well, despite the ongoing story of ETH's underperformance, ETH futures on the Chicago Mercantile Exchange, or CME, have consistently exhibited a premium versus BTC over recent weeks, signaling positive ETH demand from market participants widely considered to be smarter money than the perp-trading crypto-native apes we know and love. Meanwhile, the options market paints an overall bullish story too. Investors are paying to fence off near-term downside as puts are priced a bit richer than calls, yet the biggest money is quietly parked in December calls that would pay out if ETH can reclaim the $3,000 handle and, in a stretch scenario, double in price. So, in summary then, ETH flows are modest but positive. Fundamentals look bruised, but leverage traders are arming for higher ETH prices ahead, although they're also paying for downside protection. That split personality backdrop sets the stage for the interesting range of price targets we're about to explore, beginning with the most bullish on the street. If you ask the most optimistic asset managers deeply involved in the crypto space, 2025 will see ETH begin to drag itself out of the shadow that BTC has cast this bull run. Van Eck plants its flag above $6,000 at the cycle's top. A December 2024 note from the firm states that Ethereum macro and micro catalysts are set to converge in a solid year for Ethereum. Van Eck also anticipated new spot crypto ETPs for ETH, which we now have, and also anticipates approval for staking and in-kind redemptions, which will act as further bullish catalysts for ETH. Along with expected stablecoin and DeFi growth, Van Eck is confident that the market will reprice ETH in a reflexive manner. For some additional context, Van Eck also folds in a base case assumption that Bitcoin tops around $180,000, which would see the ETH-BTC ratio at around 0.033. The highest marquee number for ETH in 2025, though, comes from ARK Invest, which pegs a $1 trillion market cap scenario, roughly $8,000 per ETH, primarily referring to the likelihood of ETH ETF staking approval and a Trump-era regulatory reset ushering in major industry growth. A 2024 report from ARK Invest stated that, quote, "Our research suggests that, as an asset, ETH is beginning to develop attributes in the digital asset space similar to those of US Treasury bills." Then going on to state that RWA tokenization will push large pools of short-duration cash onto the chain. Keep that note in mind for later. So, taken together, these asset managers sketch a bullish band from $6,000 to $8,000 for ETH. However, you may notice that these numbers, which do not imply fresh all-time highs, are not even double the previous all-time high of around $4,900 back in 2021. In other words, even the optimistic asset managers aren't promising the kind of moves they expect for BTC, at least for the short to mid-term. That restraint will matter when we stack their models against cooler projections we're set to discuss later in the video. But at this stage of the video, if you're enjoying it so far, then be sure to give it a like, a subscribe, and hit that bell so you don't miss the next one. Now, when it comes to price predictions, you won't scroll far through crypto Twitter without coming across something from BitMEX founder Arthur Hayes. A true crypto native, having essentially ushered in perp futures to the crypto industry, he remains a staunch ETH bull. Speaking on Bankless back in May, he called Ethereum, quote, the most hated L1, precisely why he argues it's primed for a reflexive rip towards $5,000 once sentiment flips. Hayes believes the market's repricing of other L1 coins versus ETH has largely run its course. He also sees the hatred as fertile ground for upside. From the $5,000 price tag that he believes can come this year, he sketches a reflexive roadmap. Crack the old all-time high, ignite momentum traders, and a flywheel effect could spin ETH over $10,000 if liquidity conditions permit. Now, liquidity is the key piece to the puzzle as far as Hayes is concerned, and he expects a fresh flood of global liquidity to wash over the market. In recent essays and interviews, Hayes has pointed to a likely Fed balance sheet expansion, Treasury buybacks, and a China stimulus volley as the tinder that could spark off all risk assets. He argues that ETH will elastic band harder simply because sentiment is still so depressed. Hayes also considers the Pectra upgrade, which shipped in May of this year, to be a step forward for Ethereum. Pectra is regarded by some as the kind of user-friendly tweak that reignited Solana's summer of 2024. Of course, Hayes concedes that there are risks, not least of all if central banks blunder as they navigate a complex macro climate. Still, the playbook is clear. Buy the chain everyone is dunking on, front-run the inevitable narrative flip, and wait for liquidity to flow and bulls to take over. And if you want to make the most of such a bullish scenario, then be sure to check out the Coin Bureau deals page, because that's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cashback on deposits of up to 75% on crypto exchanges. These deals won't be around for long, so take advantage of them ASAP using the link down below or the QR code on the screen. Now, Hayes' eventual 10k plus ETH scenario provides the bullish ceiling for this video, but not everyone shares his contrarian zeal. That optimism sets the stage for the cooler and much lower price targets. Late last year, Standard Chartered's digital assets desk made headlines with a chest-thumping $10,000 ETH call, right in line with Hayes' longer-term view and the sort of round number optimism you expect when a new bull run is rumbling. 3 months later, the same team released a far more somber note, bluntly titled, quote, Ethereum Midlife Crisis, and swung the axe to their previous projections. The 2025 target was cut by 60% to $4,000, a level that pales next to their own BTC forecast of $150,000 plus. And I'm sure you also noticed that this revised price target sits $900 below Ethereum's November 2021 all-time high. In other words, the forecaster that sees BTC doubling its 2021 highs believes that ETH will fall short of its last top by about 20%. Jeffrey Kendrick, head of digital assets research at Standard, points to a, quote, structural bleed in Ethereum's economics. L2s such as Base, Arbitrum, Optimism, and many more now settle the lion's share of user activity while paying only scraps in fees. Standard Chartered estimates that this value leakage has removed roughly $50 billion in aggregate market capitalization from ETH by throttling mainnet burn and pushing block space demand into cheaper silos. The bank's discounted cash flow framework had assumed base layer fee revenue would soar in 2025, but the reality was not such a pretty picture, with annualized revenue now tracking $670 million, down more than 70% from 2024 levels, as mentioned earlier. Standard also stresses that, even in a scenario where US spot ETF issuers win permission to stake holdings, a significant portion of the incremental yield would be absorbed in fees and custody costs, diminishing the impact the staking yield would have. Competitive pressure, meanwhile, compounds the maths. Standard Chartered also highlighted Solana's RWA push, a partnership with enterprise blockchain firm R3 that brings HSBC, Bank of America, and Euroclear onto Solana's rails. Tron is also named a threat after it posted $760 million in fees for Q1, eclipsing Ethereum for the first time. The conclusion? Ethereum's network supremacy premium is eroding precisely at the moment its fee engine is sputtering. Now, secondary reports also discuss best-case scenarios issued by Standard in their research note. If roll-ups grow generously and funnel more sequencer profit back to the Ethereum base layer, the model lifts its ETH target to $5,400. But that still leaves ETH only 10% above its previous all-time high, and well below the $6,000 to $8,000 band touted by the likes of Van Eck and ARK. It all sounds a bit grim, but Standard Chartered are not alone in slashing their ETH price predictions. Back in December 2024, Bitwise's research team grabbed headlines with a flashy $7,000 ETH target in its 10 crypto predictions for 2025 deck. The logic was straightforward. Spot ETF inflows would swell to roughly $30 billion, with each incremental $1 billion adding 3 to 5% to price. Stablecoin settlement on Ethereum would double, and the first wave of US corporates would start holding ETH on their balance sheets. Add those inputs together and, Bitwise argued, momentum would shoot ETH to new highs. Fast forward a few months later and the song has changed. Just a couple of weeks ago, Bitwise head of research Ryan Rasmussen told the Milk Road podcast that the firm's ETH call was cut 35% to $4,500, below ETH's 2021 peak and $2,500 below the original forecast. It's also worth noting that Bitwise trimmed its SOL target as well, while leaving its $200,000 BTC view untouched. But why the revision for ETH? Well, Rasmussen cited 3 pressure points. First and foremost, spot ETH ETFs underdelivered. Bitwise's base case assumed US spot ETH ETFs would absorb $30 billion in their first 18 months. As it stands, they have only seen a little over $4 billion in net inflows. Secondly, Rasmussen notes sluggish retail demand and lackluster inflow of fresh capital. Well, I don't think you need Mr. Rasmussen or indeed anyone else to convince you of that. And finally, Bitwise raises concerns about macro and regulatory fog. The firm has highlighted trade tensions and the delayed progress on ETF staking as drags on sentiment. Although that last part has certainly seen a sharp turnaround since those concerns were voiced, with US regulators giving the go-ahead for Solana spot ETFs to incorporate staking at launch. The ETH equivalent is therefore expected sooner rather than later. Much like Standard Chartered and others, Bitwise is also concerned about Ethereum's fee revenue taking a massive hit. With mainnet currently earning roughly $2 million per day, it would need to raise that by 3 times just to get back to 2024 levels. Now, the bearish-leaning reasoning goes on, but Bitwise stops short of a doom and gloom stance. It still argues that returning to the $4,500 level is perfectly achievable even in a muddled macro tape. However, these under all-time high price targets cast a long shadow over the bullish narrative we heard from the more optimistic crowd. But such a blunt evaluation of ETH's struggles begs the question, what about the outright bearish scenario for ETH? Well, ETH has historically enjoyed a blue-chip status that largely rested on a simple idea. If banks, fund managers, and governments ever engage with crypto and settle on public rails, they will default to the network with the strongest security and deepest liquidity. However, an increasing number of analysts in the space argue that this cycle has simply nullified this thesis. In March, RWA tokenization giant Securitize, with a reported $4 billion plus on-chain, teamed up with C-DeFi project Ethena Labs and unveiled an EVM-compatible L1 built specifically for institutions. Converge promises to be, quote, the settlement layer for traditional finance and digital dollars, a pretty direct positioning to compete with Ethereum's traditional value proposition. Converge promises sub-100 millisecond blocks, KYC-gated smart contracts, and native gas paid in Ethena's own stablecoins, all while keeping every penny of fees and MEV inside its walled garden. Its roadmap pitches a Converge validator network backed by staked ENA so that governance, economics, and security stay in-house rather than bleeding to Ethereum miners or stakers. If the biggest RWA services can spin up their own high-throughput chains in weeks, well, the value proposition of paying L1 gas on mainnet starts to look like a luxury tax. And this shift is also happening outside of the EVM environment. As mentioned earlier, R3, stewards of more than $10 billion in tokenized assets for clients including HSBC and Bank of America, announced in May that its permission platform will bridge directly to Solana. VanEck has itself spun up VBIL, a multi-chain tokenized US Treasury fund. Meanwhile, tokenized stocks from RWA firm Bakkt just went live on both Kraken and Bybit as these sexes continue expanding their platforms, though I will note these tokenized RWAs are also on Solana. In addition to that, trading platform giant Robinhood officially launched a slew of crypto ventures, including tokenized stocks and its own L2. The firm stated, quote, in the future, tokenized stocks will be facilitated by our very own Robinhood Layer 2 blockchain based on Arbitrum. Now, this is a non-exhaustive list of examples, but the message is clear. Institutions and high-grade RWAs no longer need Ethereum's fee profile or its cultural heft. Due to the unbundling of blockchains and modular structures, anyone can spin up their own ecosystem. As we've looked at in this video, these shifts come just as Ethereum's own cash engine is sputtering, with base layer revenue at 30% of what it was a year prior. L2 activity is booming, but the pay rent upstairs not downstairs model means Ethereum's L1 sees only crumbs of that growth. If Converge-style enclaves and alt-EVM rails siphon off more capital, there may be no obvious catalyst to revise mainnet burn or staking yield, let alone ETH's price. Stack that reality against the official forecasts we've heard, and the picture isn't so pretty for the more optimistic ones. ARK Invest's target of $8,000 relied on very strong spot ETF inflows and major DeFi growth to match. Meanwhile, Van Eck's $6,000 target relied on Ethereum's revenue shooting up, hoping for blob space revenue to reach $1 billion. All things we don't seem all that likely to see. If the likes of Converge flourish and Ethereum's ecosystem's woes persist, Standard Chartered's $4,000 might already be the generous case. A prolonged bleed in economics could pin ETH under previous all-time highs, comfortably above cycle lows, yet still a shadow of BTC's run. From a different perspective than on-chain metrics, Arthur Hayes' bullish thesis perhaps seems more reasonable. Relying far more on the changing state of market liquidity, reflexive price action, and market psychology, Hayes' framing for a $5,000 ETH target seems more attainable. Considering this, something between the prediction from Standard Chartered and Arthur Hayes seems like a balanced take. Optimistic for some upside, but that upside does hinge on market factors beyond the control of Ethereum devs. This run has been Bitcoin-centric. BTC soaked up institutional mindshare as digital gold, while Ethereum became a utility backbone whose own coin captures less and less of the value it enables. However, this is crypto, and logic goes out of the window when risk-on sentiment takes over. But what do you folks think? Has the criticism of Ethereum this cycle gone too far? Is it gearing up for a most hated rally as per Hayes' vision? Let us know in the comments below. Alright, if you enjoyed diving into ETH's price predictions today, then do yourself and us a favour. Hit that subscribe button and tap that bell so you can keep up to date with everything happening in the world of crypto. That's me for today, folks, but thank you all for watching, and I'll see you next time.